Welcome back, students and scholars. In this episode, we continue ASC 250 and focus on misstatements and materiality. In video 4, we studied how to correct a material prior period error once restatement is required. Today, we step one level earlier and ask a more judgment heavy question. How do we evaluate whether a misstatement matters enough to require correction in the first place? We will cover uncorrected misstatements, known versus likely misstatements, the rollover method, and the iron curtain method. This is where accounting becomes less about automatic mechanics and more about disciplined professional judgment. Why does this video exist? Because not every misstatement is treated the same way. Some misstatements are clearly material and must be corrected. Some are clearly immaterial but still need tracking. Some look small in dollars but are serious because of what they hide. Size matters, but size is not the whole story. Nature matters, accumulation matters, and judgment matters. A misstatement that changes a loss into income, hides a covenant breach, or triggers management compensation may influence users even if the dollar amount seems modest. So today, we are not simply asking how big is the number, we are asking would this matter to a reasonable user? Our learning path has four stages. First, identify the misstatement and document the issue. Second, classify it as known or likely. Known means the amount is specifically determinable. Likely means the amount is estimated through judgment differences or sampling projection. Third, evaluate materiality using both quantitative and qualitative factors. Fourth, choose the correction path, adjust, disclose, restate, or track forward depending on the facts. The important discipline is not to collapse these stages. If we jump from small amount directly to ignore it, we may miss a qualitative issue or an accumulated balance sheet problem. Good judgment moves step by step. An uncorrected misstatement is an identified error or misapplication that has not yet been adjusted through a journal entry. It may be found during audit work, management review, internal control testing, or closing procedures. Detection alone does not automatically decide the treatment. Management evaluates the issue, auditors review the evaluation, and the item is considered individually and together with other misstatements. The correction decision may be to adjust immediately, to disclose, to restate prior periods, or to carry the item on the unadjusted differences schedule for continued tracking. The key idea is simple: uncorrected does not mean forgotten. Why do some misstatements remain uncorrected? Because immaterial items may not justify adjustment in the current period, but that decision still requires documentation. There may be cost and timing considerations. The dollar amount may be clearly below the quantitative threshold. Management and auditors may conclude that a reasonable investor or creditor would not change a decision because of the item. But even then, the item must be tracked. Immaterial does not mean invisible. A small amount this year, another small amount next year, and another small amount after that can grow into a material accumulated issue. Accounting memory matters, especially when errors keep coming back, politely wearing small number costumes. Materiality has two sides, quantitative and qualitative. The quantitative side asks whether the dollar amount is large enough relative to a relevant base, such as net income, total assets, revenue, or equity. It also asks whether misstatements become material in aggregate. The qualitative side asks whether the nature of the issue makes it important even if the amount is small. Does it hide a trend, convert a loss into income, affect a loan covenant, trigger a bonus? The legal and regulatory view of materiality centers on whether a reasonable investor would consider the information important. So, materiality is not a calculator button, it is a user focused judgment. Known misstatements are the easier category to understand because the specific amount can be identified. There is a clear transaction, balance, entry, or accounting decision that is wrong, and the correction amount is measurable without projection. For example, an expense recorded in the wrong period, an asset measured at an incorrect amount, or a journal entry posted to the wrong account may create a known misstatement. The important point is certainty. We know the amount, we know the correction. The judgment then moves to materiality. Is this known misstatement material individually or when combined with other uncorrected misstatements? Known errors commonly arise from several sources. A wrong principle may be applied, such as using a method that does not conform to US GAAP. A processing error may occur, such as a duplicate entry, transposition mistake, or wrong account code. Data may be misread, such as misunderstanding a contract term, unit price, or foreign exchange rate. A concealed issue may also exist, such as an omitted liability or revenue recognized too early. These examples share one feature. The error can be tied to a specific fact pattern and a specific amount. The correction is identifiable. The harder question is whether the item is material. Likely misstatements are different because the exact amount requires estimation or projection. There is evidence that a misstatement exists, but the full amount cannot be measured directly. The two common sources are judgment differences and sampling projections. A judgment difference may occur when management's estimate falls outside a reasonable range. A sampling projection may occur when errors found in tested items are projected to the full population. Likely misstatements are not imaginary, they are evidence based estimates of misstatement. They belong on the unadjusted differences schedule and must be evaluated along with known misstatements. Let us look at an estimate difference. Suppose management estimates warranty expense at $180,000. The auditors perform an independent analysis and conclude that the reasonable range is $220,000 to $260,000. Management's estimate is below the low end of the reasonable range. The likely misstatement is $40,000, which is the difference between management's estimate and the nearest end of the auditor's reasonable range. We do not automatically jump to the midpoint. The nearest end approach avoids overcorrection and identifies the minimum likely misstatement that must be evaluated. Sampling projection is another source of likely misstatement. If auditors test a sample and find errors, those errors cannot always be limited to only the tested items. The sample represents a larger population, so the error rate or dollar error found in the sample is projected to the full population, producing an estimated likely misstatement. For example, if a $30,000 sample drawn from a $300,000 population contains $3,000 of misclassification, that sample evidence may suggest a broader population issue. The projected amount, along with sampling precision and other risk factors, is evaluated against materiality. Now we move to qualitative factors. A small misstatement can still be material because nature changes everything. Four common qualitative factors are trend masking, loss to income, covenant compliance, and compensation effect. These factors matter because financial statements are not read as isolated numbers. Users read patterns, thresholds, and signals. A misstatement that hides a declining margin may be more important than the same dollar amount in a stable account. A misstatement that affects a covenant may be more serious than a larger amount with no decision impact. Materiality asks whether the user's judgment could change, not merely whether a percentage threshold was crossed. Trend masking occurs when a misstatement hides a performance pattern that users rely on. Investors and analysts often study revenue growth, margin movement, and operating income trends to assess future performance. If an expense understatement makes a weakening margin look stable, the dollar amount may appear small, but the trend effect can be significant. The question is, would correcting this item change the direction, slope, or meaning of a key trend? If yes, qualitative materiality may be present. Students should watch carefully for exam questions where a small misstatement changes the story over several periods. Trend distortion is often the clue. The loss to income factor is powerful because direction can be more important than size. Suppose the corrected result would be a net loss of $8,000, but the reported result shows net income of $5,000. The total swing is $13,000, which may fall below a simple quantitative threshold. But the qualitative effect is major. Users see profit instead of loss. A lender, investor, or board member may interpret the entity very differently. Crossing from loss to income changes the narrative. In financial reporting, crossing zero is not just math. It can change confidence, valuation, and decision making. Covenant breach risk is another major qualitative factor. Loan agreements often include financial covenants such as maximum debt to equity ratios, minimum current ratios, or minimum interest coverage ratios. A misstatement may look modest in absolute dollars but still hide a covenant breach. For example, a reported debt to equity ratio of 2.3 to 1 may appear safely within a 2.5 to 1 limit. But if correcting a liability moves the ratio to 2.7 to 1, the borrower may be in technical default. That affects lenders directly. When a question mentions a covenant, ratio limit, or contractual threshold, do not evaluate size alone. Compensation triggers also add qualitative weight. Suppose management earns a bonus if net income exceeds $500,000. Reported net income is $507,000, but it includes a $15,000 expense understatement. Corrected net income is $492,000, below the bonus threshold. That misstatement may be material because it directly affects compensation and raises concerns about management bias. The issue is not only the dollar amount in the financial statements, it is the incentive attached to the number. Whenever a misstatement crosses a bonus, target, or award threshold, qualitative materiality becomes very important. Prior year misstatements create accumulation risk. A small error in one year may be judged immaterial. Another small error in the next year may also be judged immaterial. But if both remain uncorrected, the balance sheet may carry an accumulated misstatement that becomes material later. In the slides example, $18,000 in year 1, $9,000 in year 2, and $13,000 in year 3 produce a $40,000 accumulated balance. If the balance sheet threshold is $35,000, the accumulated position becomes material. This is why the unadjusted differences schedule is not paperwork decoration. It is the memory system for materiality. The rollover approach focuses on the current period income statement effect. It asks, what would correcting the misstatement do to this period's earnings? It considers the originating effect of the current year misstatement and any reversing effect from prior year misstatements that flow through current year income. Its strength is that it directly evaluates whether current year performance is distorted. Its weakness is that it may miss a growing balance sheet problem. If small misstatements accumulate year after year without a large current year income effect, rollover may say not material, while the balance sheet quietly becomes wrong. Quiet problems are still problems. The Iron Curtain approach focuses on the total accumulated misstatement in the ending balance sheet. It asks what adjustment would be required today to make the balance sheet correct. This method is strong because it catches multi year buildup. If prior year misstatements were never corrected, the ending balance sheet may now be materially misstated, even if no one year's income effect looked material. But Iron Curtain has a weakness too. Correcting the entire accumulated amount in the current period may create a large current year income effect that does not reflect current year operations. So, Iron Curtain sees balance sheet truth, but correction timing still needs judgment. Comparing the two views helps us understand why both are needed. Rollover focuses on current income, Iron Curtain focuses on accumulated position. Rollover is good at identifying whether this year's earnings story is distorted. Iron Curtain is good at identifying whether the ending balance sheet carries too much accumulated error. Neither method is perfect by itself. That is why public registrant guidance expects both views to be applied. If a misstatement is material under either view, the correction path must be considered carefully. The two methods are not enemies. They are two lenses looking at different dimensions of the same reporting risk. Now let us apply this using Meridian Office Systems, a fictional company. During the 2027 audit, auditors identify that a service cost accrual has been overstated across 3 years. The overstatement was $18,000 in 2025, $9,000 in 2026, and $13,000 in 2027. No prior correction was made. The accumulated overstatement is $40,000. This case is useful because each annual amount may look manageable, but together the amounts create a larger balance sheet issue. We will test the same facts using rollover and iron curtain. Under the rollover calculation, we evaluate only the 2027 income statement effect. The current year overstatement is $13,000. The income statement materiality threshold is $20,000. Since 13,000 is below 20,000, the rollover approach concludes that the current year income effect is not material. If we used rollover alone, management might think no correction is needed, but that would be incomplete. The whole point of this example is that the current year income effect is only one view. The accumulated balance sheet effect may tell a different story. Under the iron curtain calculation, we evaluate the total accumulated overstatement embedded in the ending 2027 balance sheet. That includes 18,000 from 2025, 9,000 from 2026, and 13,000 from 2027. Total buildup is $40,000. The balance sheet threshold is $35,000. Since 40,000 exceeds 35,000 by 5,000, the ending balance sheet is materially misstated under the iron curtain view. This result catches what rollover missed. The income statement effect looks small, but the accumulated balance sheet problem crossed the materiality threshold. The dual evaluation result is the lesson. Rollover says the 2027 income statement effect is below threshold. Iron Curtain says the accumulated balance sheet position is above threshold. Because the misstatement is material under at least one view, Meridian must consider a correction path and related disclosure. This is not a contradiction. It is exactly why both methods exist. One method protects the current year earnings analysis. The other protects the ending financial position. A disciplined accountant does not choose the method that gives the most comfortable answer. A disciplined accountant evaluates both. Now we introduce the Securities and Exchange Commission or SEC view. The SEC staff issued Staff Accounting Bulletin No. 108 or SAB 108 to address how public registrants evaluate prior year misstatements and preparing current year financial statements. SAB 108 is not a new accounting standard like a new accounting standards update. It is SEC staff guidance for registrants. The key instruction is dual evaluation. Use both rollover and iron curtain. If a misstatement is material under either view, it cannot be dismissed simply because the other view looks clean. This is why full forms matter before abbreviations, especially for students. The SAB 108 decision flow is structured but still requires professional judgment. First, test the income statement view using rollover. Second, test the balance sheet view using iron curtain. Third, ask whether the misstatement is material under either view. If the answer is yes, the correction path must be considered. That may involve restatement, current period adjustment, opening retained earnings adjustment in specific circumstances, and disclosure. The critical point is that a clean rollover result does not erase an iron curtain problem, and a clean iron curtain result does not erase a current earnings distortion. Both gates matter. SAB 108 also included transition relief when it was first adopted. Some registrants discovered accumulated misstatements that had not been material under rollover in prior years but became material under iron curtain. Restating multiple prior annual reports could have been extremely burdensome. The SEC allowed qualifying first time adopters to record the cumulative correction as an adjustment to opening retained earnings rather than restating all prior periods. But this relief was not a silent cleanup. Disclosure was required, including the nature, amounts, periods affected, and why the items had previously been considered immaterial. Relief does not mean hiding, it means a practical correction path with transparency. Interim reporting needs separate care. ASC 250 points preparers to ASC 270, interim reporting when misstatements affect quarterly financial statements. Quarterly periods may involve different materiality considerations from the full annual period. A misstatement discovered in the third quarter may require evaluation against earlier quarters, not only the annual total. Correcting an interim period error in a later quarter may also require specific disclosure about the nature, amount, and period of the original error. We are not doing a full ASC 270 lesson here, but students should remember the bridge. Interim reporting is connected, but it has its own detailed rules. Disclosure is part of the judgment story. When a misstatement is corrected, users need to understand what happened, which periods were affected, and how management reached the conclusion. The notes should describe the nature of the misstatement, including the account affected and how it arose. They should identify the periods and line items affected across the financial statements. They should explain the correction method, whether restatement, cumulative opening retained earnings adjustment, or current period correction. They should also explain the materiality judgment, including the framework applied. Good disclosure is not a formality. It is the bridge between technical correction and user understanding. Let us finish with the main exam traps. First, do not use only percentages. A 5% or 10% benchmark may be a starting point, but qualitative factors can override a small amount. Second, do not ignore qualitative factors such as trend masking, loss to income movement, covenant breach, or compensation triggers. Third, do not forget accumulation. Small misstatements can build into a material balance sheet position. Fourth, do not mix rollover and iron curtain. Rollover is current period income focus. Iron curtain is accumulated balance sheet focus. Under SAB 108, registrants apply both separately. One clean test does not cancel the other. That completes our lesson on misstatements and materiality under ASC 250. Remember four essential ideas: classify misstatements as known or likely, evaluate both quantitative and qualitative materiality, apply rollover and iron curtain correctly, and use SAB 108 dual evaluation for SEC registrants. In the next episode, we will bring the whole ASC 250 topic together through practice questions and revision. If this video helped you, please like it, subscribe to the channel, support the channel, and share it with your colleagues who are studying or working with financial reporting. Your support helps this channel reach more serious accounting learners. I will see you in the final practice lesson.